You're pretty positive. I mean, you were on with us a few weeks ago, and you said buy the dip during May. That turns out to have worked.
Yeah.
The question is, what happens next?
Yeah, you know, what I would say is basically, if you think about the S&P 500 and take sort of a slightly bigger picture view, we've actually been trading in a range for about a year and a half. It's a pretty wide range. And of course, you know, as you sort of approach the top, you have to think about, like, you know, is the top going to hold again? And I would argue it very likely is going to hold. So, you know, I remain very much of the view that things actually do need to get worse before they get better. I think, you know, what you have to keep in mind is that...
On the trade front, on the economy front, what are you referencing?
I would say the markets and the economy. So, you know, if you just draw a simple chart of the S&P 500 the last 2 years, and you put a line through the peaks and ask what happened on that day, pretty much to the day, you know, we got basically an escalation of the trade war each time. So as you approach that point, you know, the administration taking the view that the economy and the markets are in pretty good shape, you know, there's every reason to expect more of the same. I would argue, you know, there's a lot of discussion about, is there a Trump put in the market? I would say the put, you know, if it's there, it's like way lower. It's probably down at 27.50, and it's probably not very effective. I would argue what, you know, is likely to be a potentially very important trigger is, if you look at the manufacturing ISM in the U.S., you know, you see after the presidential election that we basically went up and stayed up in what is a very unusually long period of very strong growth in manufacturing. Starting, you know, late fall last year and into the winter, basically, we have come all the way down. So I would say the entire Trump bump to manufacturing ISM has now been completely wiped out. And the next stop is likely into recession territory. And manufacturing in the U.S., you know, in recession, even if we are still just only talking about the surveys, has a you know, strong potential to basically change the narrative and provide an incentive to reach an agreement basically on trade.
Yeah? Lizanne, David Solomon told Carl Clinton here yesterday that he felt that the market had already priced in rate cuts, and therefore there was a risk to downside if that didn't happen. Where do you stand on that?
That actually may be the case.
I was told to look at camera 6. I'm not used to sitting on this seat.
Yeah, no,
Sorry, Lizanne, continue.
I think there is a risk that maybe the market has gotten a little bit too aggressive in terms of what it's pricing in for the Fed. The Fed's been pretty clear that they want to see the actual data in the economy and that they're not going to be swayed simply by market action. But let's assume they are swayed by market action. The latest market action does not point to the need for a rate cut as early as June. I mean, maybe you get it in July, but I think they're going to actually want to point to something in the data that's concrete. Now, if you look throughout the past many years, and you look at where the market ends up pricing in Fed expectations and what ultimately the Fed does, there's a pretty big disconnect between those two things. So I do think that the market may have gotten a little bit ahead of itself, at least pricing in 3 cuts for this calendar year.
Still, Lizanne, I mean, look at the CPI numbers today, 0.1% month over month. Core was pretty soft. This pretty much gives the Fed an excuse, along with a weaker jobs number, the fact that they're constantly below target on inflation, to at least change their tune and start to lay the groundwork for a cut. Would you agree?
Well, I think they have laid the groundwork for a cut, and I think the changing of the tune occurred in January when, in reflection of this disinflationary trend, they moved from a much more hawkish position, having just raised interest rates in December, to pause mode that they're in. We just think that, at least for the June meeting, they're more likely to stay in pause mode than use that as the first launch point for a rate cut. We think that if we're going to get a rate cut and it's in the near term, it's more likely to be in the July meeting than the June meeting.
Is there too much hope in the market, Binky, for a rate cut at this point?
I'm not sure I would use the word hope. I'm not sure that actually cutting rates is going to really be helpful for the U.S. equity markets. And I would argue, you know, both from a signaling point of view, both from a fundamental point of view, rate cuts, you know, if they do impact growth, you know, it takes about a year and a half. So we're really talking about multiples going up.